A call option is a financial contract giving the holder the right, but not the obligation, to buy a stock by a certain date. And so it's called an option because we have the option to buy the stock. We're not obligated, but we have the right to exercise that option if we choose so and if the conditions make sense to do that. So there's two different sides that we can be on in an option contract. The first one would be long. And so if we were long, we could pay a premium to be long, which means we're the ones that own the contract. Or we could be short, which means that we received a premium to be short. So we are now obligated to potentially pay the person who bought the contract from us a certain amount if they exercise the option. Now let's just get into some examples and it'll make more sense. Let's draw the profit and loss diagram for a call option in which we are long. So we own this call option. Let's read the example real quick. An investor purchases a long call option contract on company XYZ with a strike price of $100. So the strike price is the amount that we're able to buy this stock at. So $100, so that's why I put X exercise price equals 100. The premium for the option is $10. So we paid a $10 premium to purchase this option in the first place. Assuming the investor holds the option until expiration, create a profit and loss diagram showing the potential profits or losses at various stock prices for company XYZ at the time of expiration. So there's just a few things we're going to want to go through quick. So one is this variable C. So C equals the value of the call option. And C is going to be equal to the maximum of either the stock's price, so just think of S as this underlying stock's price, minus X, so X is the amount that we're able to sell the stock for, so 100, or 0. So this value of C can never be less than 0. All right, so the profit is going to be equal to the value of that call option C minus the original premium that we paid of $10. Got it? Good. So now we'll go down to our profit and loss diagram. So on this axis here, this vertical axis, we can see our profit and losses. So if we're above this 0 mark, that means we've made a profit on this contract. Whereas if we're below this 0 mark, that means we have made a loss or lost money on this contract. Now let's start drawing our diagram. So initially we pay $10 for this option contract. So we know that if the price of the stock was below $100, we can't really exercise this option contract. The only time that it makes sense to exercise this contract is when we can buy that price, buy the stock for less than it's actually worth. And the only time that we could buy the stock for less than it's actually worth is if the price is over $100. So any point in time where the price is below 100 or equal to 100, we have essentially just lost $10. We've lost the $10 premium that we initially paid. But once we start getting past $10 or that $100 mark, we start to recoup some of our losses. And so let's just draw a line right here. So we're going to 110. And 110 is our break-even point. And why is that? Because if the underlying stock price, S, is equal to 110, and X is equal to 100, then this value becomes 110 minus 100, which means that the call option's value is $10. And then if we want to calculate our profit, then we take our $10, that is the value of our call option, and subtract the $10 premium we paid, and our profit is equal to 0. So that's why when we hit 110 on this timeline, we are exactly equal to 0 profits and losses. However, if the price of this underlying stock continues to rise, we'll see that we're actually going to start making more money. I'm going to try to draw as straight of a line as possible. Cut me some slack, it's not that easy. So let's draw a line like that. So then once we get, let's say, to 120 as an example. So let's say we're at 120. So we hit 120, and that means that the price of this underlying stock is equal to $120. I can buy a stock that's worth $120 for only $100. So I'm really up $20 on the value of my call option at this point in time. However, that $20 is going to be subtracted by the 10 I initially paid, that premium, to come up with my profit of $10. And then you can see as we keep going up, once we get to 130, we're up $30 on the value of our call option, but we paid $10. So really, we're only going to be profiting $20 at that point in time. And so we can just keep continuing this line out into the future. And as long as the stock price keeps going up, we keep making more money as the owner of the call option. Now, let's draw a payoff diagram for the opposite side of that call option. This is going to be for the investor that sells a short call option contract, right? And we're just going to do the same thing, but for this short call option, the strike price again is going to be 100, and the premium that was received for the investor that sold the call was $10. Again, so X is still 100, premium is still 100. The value of the call option is still equal to the maximum of the underlying stock price minus the $100 exercise value, or 0. So the call still cannot be below $0. But this time, the profit to the short side of that contract is the premium minus the value of the call. This is the reverse of what we saw on the long side of the call, which was the profit was the value of the call minus the premium. So basically, whatever one side of the contract loses, the other side gains. And this is going to be quite simple now that you know how the long call works. So if I'm selling this call, I'm up $10. Unless the stock price goes past $100, I am up $10. I've gained $10 because I sold this call option for $10. However, once the price of that stock starts going past 100, I've got the same break-even point as the other person. Because if this is 110, if the underlying price of the stock is 110, then the value of this call option is 110 minus 100, so $10. And then my profit is equal to 10 minus 10, which is $0. So it's the same break-even price. However, if the price keeps going down, it's going to go like this. So once we get up to, say, 120, now we have lost $10. And the reason that we've lost $10 is because the value of the call here is going to be $20. So our profit is 10 minus 20. And so we've lost $10. And so on the long side of the call, where we had this unlimited upside, on the long side it looked something like this, if you remember correctly. And if the price of the stock kept going up, we could just keep making more and more and more money. So we had unlimited upside. However, when we sell the call, the best we can do is gain $10. But we have an infinite ability to lose money because the price of the stock could keep going up and our losses could just continuously get larger and larger.